All right, good evening, Balikis. How are you doing? And welcome to class today. All right, good evening, everyone, and welcome to accounting class for today. I just had to wait a little bit for you guys to join before I began, so that I would not, just be talking to myself. So it's good to have you guys here. All right, so we'll be talking about final account of a sole trader today. Final account of a sole trader. Final account of a sole trader. All right, Balikis, do you have any question that you might probably want to ask? Maybe from any of our previous lecture. I'm giving you an early responder coupon. So if you have any question, maybe something based on what we have been treating, and then maybe while you were reading, solving a question, you did not get something. If you don't, it's fine. You can just say no, so that we'll continue the class. So I'm waiting on you. Any question? Any question? Any question? All right, then, so let's continue our class. So now today we are going to be talking about final account of a sole trader. Final account of a sole trader. Final account of a sole trader. All right. Now, these are our lesson objectives. At the end of this session, you should be able to. These are the major things that will be determined in this lecture. We'll be determining. We will be learning how to determine our cost of sales. Don't worry, another name for your cost of sales is cost of goods sold. So you might not know it as cost of sales, all right? But it's cost of goods sold. So we learn how to determine our cost of sales, our gross profit, our net profit. We will be able to identify non-current assets, current assets, long-term liabilities, current liabilities, and proprietors capital. And of course, if time permits us, then we'll be able to move into adjustable items on expenditure and income. And don't forget, whenever you hear this, know that we are just talking about final adjustment, which is a form of accruals and prepayment. Is that fine? So it's as simple as that. Then of course, if time permits, we would also talk about bad debt and provision for doubtful debt. All right. So now let's think about it. What is final account? Final account. Now, just as the name implies, final account is like the final account that you prepare. What does that mean? Your final account is your financial statement, all right? They are known as your financial statement, and it is the final destination of all transactions in the accounting process. Now, don't forget, I told you guys that there is something called the bookkeeping process, where transactions move from your source document. Don't forget, your source document serves as the evidence that the transaction took place. From the source document, it moves into your subsidiary books. From the subsidiary books, it moves into the ledger, and from the ledger to the trial balance. Is that fine? All right. So now this is the old bookkeeping process. But don't forget, when in our introductory lecture, I explained to you guys that one major difference between bookkeeping is that bookkeeping and accounting is that bookkeeping covers a smaller scope, but accounting goes beyond all of these things. All right, it goes beyond this. It goes into even analyzing and summarizing financial statements. So after you get your trial balance, which is the final stage in the bookkeeping, this final stage of bookkeeping is the beginning stage of accounting. Do you understand that? So where bookkeeping stops is where accounting starts its own work. So after this, then you use your financial statement for accounting. You use this trial balance rather to prepare something called your final account or your financial statement, anyhow you want to call it. Is that fine? So this is what we have. Now, they are prepared at the end of the accounting period. So see another reason why it's called final account. That's why it's the final destination of transactions, because it is prepared at the end of the period to show that during this period, we want to know what our financial performance is and what our financial position is. So it is prepared to show the financial performance and position of the organization. Now, normally, the final account consists of the following. Based on this level, you have your trading account, you have your profit or loss account, and you have your balance sheet. Is that fine? Now, the combination of these two are actually, they are mostly prepared together. They are always prepared together. It's called the trading profit or loss account. Is that fine? The trading profit or loss account, or your income statement. So if you see something, if you see an income statement, just know that they are talking about your trading profit or loss account. Do you understand that? Now, it can also be called statement of profit or loss. Now, this is the IAS name, International Accounting Standard. This is the name they gave to it. All right. And of course, okay, this name, the full name of this is actually Statement of Profit or Loss and Other Comprehensive Income. All right, but you don't actually need to know about that. So it's not this level. You don't need to know about that. Then this your balance sheet is, of course, it's normal balance sheet that you know. Another name for it is the Statement of Financial Position. Is that fine? Now let's look at the trading account. Now the trading account, don't forget, when you prepare your statement of profit or loss, you have like two sections. Now one section to calculate your gross profit, and the other section where you calculate something called your net. Now it is inside the trading account that this one is calculated, and inside the P&L account that this one is calculated. Do we understand that? Are we together, by the kiss? All right. So your trading account is the final account prepared to show the gross profit or gross loss for the period. All right. So when you are talking about this one, we are saying at the end of the period, though, you have to know the gross profit. Now, when you are talking about gross profit, you are talking about the profit from the ordinary course of business. Do you understand that? So the profit that the organization has made from doing its normal business, ordinary course of business, normal business. All right. So maybe I sell rice now. I want to know the profit that I made from my business of selling rice before thinking of other business expenses that are not directly related to me selling rice. Do you understand that? So how do you get that? You have to look at the difference between your sales, which is the sales of rice, and the cost of goods sold or cost of sales. Now, this cost of goods sold is the cost that you incurred before you were able to sell rice. Cost that you incurred directly in the ordinary cost of business is your cost of sales. Do you understand that? So your cost of sales is what? The cost that you incurred in the ordinary cost of business. Why sales or revenue, another name for sales, it can also be called revenue, is the income that you made in the ordinary course of business. That's what I wrote here. Revenue is earned in the ordinary course of business. I hope you understand that. So I wanted to just use this to explain before, but let me rewrite it. Kumi, is this the same Kumi? Did you change your name? I want to be sure if it's the same one. Adekunmi Olaleye or something. Good evening. Did you change your name? Are you the one? All right. Sorry about that. So now let's continue. So this is done by getting the difference between sales. Is the same one. All right. Maestro Kumi. That's nice. You changed your name overnight. So this is done by calculating the difference. And don't forget, I said this sales is your revenue. That's money that you made in the ordinary course of business. So please, I hope you guys are noting all of these things down. All right, these are likely stuff that they can ask you. All right, you must understand this thing. It is OBJ. They will just ask you to analyze it. All right. So, and then cost of goods sold, of course, is cost that you incurred in order to make those sales. All right. Now, how do we calculate our cost of goods sold? Because don't forget, I said the first objective here is you want to determine how to calculate cost of goods sold. Those are the kind of questions they can ask you. How they can give you a list of items and they will tell you that from what you have, calculate cost of goods sold. Is that fine? Now, this is how you calculate cost of goods sold. So let me draw up the format for your trading account. You have your debit here, you have your credit here. So you have, so just as I told you, we always calculate everything together. I mean, prepare it together. You say, for the year ended 31/12/2025. Is that fine? So you have a naira sign here, you have a naira sign here. Now we want to determine how to calculate cost of sales. All right, but I want to since it's inside the same format, so that's why I'm doing this. Now on the credit side of your trading profit or loss account, you have your sales, and then you have your returns inwards. Guys, what's another name for returns inwards? I'm waiting for your answer. Sales minus returns inwards gives us something like net sales or net revenue. Sales, another name for returns inwards. So to get your cost of sales, you have to go to the debit side. It is on the debit side that you calculate your cost of sales. So you start with opening stock. Don't forget, what we want to get is the cost of goods that we sold. So we must be able to know the cost of goods that we actually have, that we had during the year, before we can know the cost of goods that we sold. Is that fine? Don't forget, name that called none abet. All right, you cannot give what you don't have, you cannot sell what you don't have. So we must first determine the cost of goods that we actually had before we now determine the ones we sold, because it's out of what we have that we sold. So opening stock. Now, opening stock is the amount of inventory that you have, all right, the amount of goods that you have at the beginning of a particular period. So, say this is 1 January 2025. If I would look through my warehouse, I look at the goods that I have, the value of those goods is my what? Is my opening inventory. So, I know that at the beginning of the year I had this, but of course, I will not only sell what I have as opening stock, I will also buy more so that I can have more to sell. So, that will be what? You say add purchases, add carriage inwards. Now, you add other direct costs, all right, costs that are direct to the process of purchasing. Your carriage inwards is the cost of transporting goods to the company. So when you go outside to buy goods, the cost that you incurred in order to transport those goods to you is called carriage inwards. Is that fine? So X add wages. Now please pay attention. If you have ordinary wages, you add it. But if you have wages and salary, or only salaries, it does not come here. You take it to profit or loss under business expenses. Is that fine? So add wages, then less returns outwards. Are you guys with me? I was asking a question, nobody responded. What's another name for returns inwards and another name for returns outwards? Less returns outward. Don't forget, this is returns outward. Less less goods withdrawn. Now, this item that you have, this amount is your cost of goods available for sales. Now, what does that mean? Don't forget, I said we want to first determine the amount of goods that we have that we can even sell before we know the amount of goods that we sold. So, at the end of the day, we notice that the cost of goods that we have to sell is what? Is this amount. Now, of course, you remember what it turns out what is. Now, goods withdrawn is any if the owner of the business takes business goods out for personal use, then it is called goods withdrawn and it is deducted there. Do we understand that? Don't forget, I said under drawings, you can either withdraw cash for personal use or withdraw goods for personal use. Now, if you are withdrawing cash for personal use, it's not affecting this one. It's not affecting your trading profit or loss account. But if you are withdrawing goods, you are taking out business inventory to cater for personal needs, then that's what? Goods withdrawn. Is that fine? So cost of goods available for sales. All right. So now, if this is the amount of goods that I have for sale during the period, the total number of goods that I could sell. For example, you are saying that I have a total of 100 million. How can I know the amount that I have spent out of this 100 million? I will check the remaining money with me now. So if I count the money, if I check the money in my account and I notice that it remains just 15 million, then it means that I must have spent 85 million. Is that fine? So it is in the same way. If we have cost of goods available for sales, to determine our cost of goods that we actually sold, we have to use our remaining goods, the cost of the remaining goods at the end of the period. Now, the cost of the remaining goods is called closing inventory. Now, this closing inventory has to be deducted from your cost of goods available for sales. When it is deducted, that's when you have what we call your cost of goods sold. So that's practically the form how you calculate your cost of goods sold. Now, on a more basic level, if there's no carriage inward, there's no wages, there's no um goods withdrawn and all, your cost of goods sold will just be opening stock plus purchases plus minus returns outward minus inventory. It's as simple as that. Without all of this carriage inwards, wages, goods withdrawn. If you have just these basic things, because these are the most basic ones that are most common. If you have all of these things, then this is everything you need to calculate your cost of goods sold. Do you understand that? So this is how you arrive at your cost of goods sold. Is that fine? All right. Now, if your cost of goods sold is XX, don't forget that the major purpose of your trading profit or loss account, sorry, your trading account, this trading section, is to arrive at gross profit. So what happens here is you have to use gross profit as a balancing figure. How do you do that? What's the total here? Most times this side, your credit side will be greater than your debit side. And don't forget, when your credit side is because your trading account is an income account, once your credit side is greater than your debit side, it means that you have a profit. But if by adventure your debit side is greater than your credit side, then what you have is called a gross loss, which is actually not that common. Is that fine? So you take the total of this side, the total of your credit side, you put it here too. The balancing figure, that will be this one minus this, it gives you your gross profit. Please, do we understand? I need your response. Let me know if you understand. I'm moving on. Do we understand? Do we understand? What of Kumi? Thank you, Balikis. Kumi, do you get? All right then. So let's continue. So this is the format for what? For your trading profit or loss account. Now, I gave a little. There's a question here. So this is a this is a specimen question from last year's exam. Sorry. I don't know. I think I've done something to this question. So let me write it for you guys. So it's a specimen question from your past question, actually from last year's question. I'm showing you live and direct ways they can ask question. Ways that this particular question can come out. So you have, did I write it somewhere else? So you have something like this. They now said your opening stock is 80,000 naira. Please pay attention, guys. Your sales is 300,000. Returns inward is 30,000. Don't forget, we are deducting it. That's why it's in brackets. Then you add your purchases, which they said was 90,000. By the time you add these two together, you have 170,000. This 170,000 is your cost of goods available for sales. Then you have your closing stock. Now, this your closing stock is an unknown figure. Then there is also an unknown figure here, which is your cost of goods sold. Then you have your gross profit to be 150,000. Then the account is closed. Total of 270,000 on both sides. Now, based on what we have done, so the question says determine the closing stock. They didn't give us closing stock. It told us to determine closing stock. So this is one of the ways they can ask you this question. So determine closing stock. Now, option A 30,000, option B 40,000, option C 50,000, option D 60,000. Now, who wants to solve this for us? Who wants to drop the answer for closing stock for us based on the format that we just learned? Closing stock, closing stock. Closing stock. Who wants to do this for us? I expect you guys to be calculating. I'm expecting your responses. I'm expecting something from you, Balikis Kumi. What's your answer? This is the question now. Now you see that this is question mark, this is question mark. So with everything that you have here, Balikis, did you get it? With everything that you have here, the question is Determine your closing stock. That's why I'm trying to read it out for you guys now. Your trading account, opening stock is 80,000, purchases is 90,000, cost of goods available for sales is 170,000. Then your closing stock, question mark, we don't know what that is. Your cost of goods sold, question mark, we don't know what that is. Then your gross profit is 150,000. As I said, you should note it down as I was writing it. Then your total is 270,000. Your sales is 300,000. Your returns rewards is 30,000. That gives us a net. So a net of 270,000. So Kumi said cost of goods sold is 150,000. Let's see how correct it is. Then what's our closing stock? Because that's the question. So Balikis, I don't know if you saw if you get it now. Closing stock is 20,000 naira. So this is Kumi's answer. He said closing stock is 20,000. Now Balikis, give me your answer. Work on it and give me your answer. Balikis, are you there? Work on it and give me your answer. Alright, in order not to delay ourselves, and Kumi, let us confirm whether the answer you give us is correct. You say your closing stock is 20,000 naira. But don't forget, your gross profit is 150,000 naira now. How is your cost of goods sold also 150,000 naira? That does not work. Think about it. It's not correct that way. Now, how do you solve a question like this? Look at it. You have 270,000 here, and you have 150,000 here. Now, logically, it means that anything that must have given you, if you have 150 here and you have 270 here, then this figure here must have been, sorry, this 270 here must have been this plus this, because obviously this one is greater than this one. So it must have been gross profit plus cost of goods sold that gave you this one. There's a mistake in what you did. So 270 minus 150,000. If we use a calculator, that will give you 120,000. So it means that your cost of goods sold is actually what? 120,000 naira. Now, of course, if this is 170,000 and this is 120,000 naira, then you know that before you could arrive at this 120,000, you must have deducted whatever it is was here. So to get this back that you don't know, this is x. All right, you can say this x equals to 170,000 minus 120,000. So that x, so what does that give you? It gives you 170 minus 120 gives you 50,000 naira. So it's actually as simple as that. So If you want to do it like maybe let me convert it to mathematics for you. Let cost of goods sold be X. You have approved that these answers are not correct. There was a mistake on Kumi's part. So let your cost of goods sold be X and let your closing inventory be Y. All right. Let's start from cost of goods sold, which is X. As we can see here, your gross profit, don't forget, is equal to your net sales minus cost of goods sold. Now, let us now put figures to this thing. What's our net sales? What's our gross profit rather? 150,000. What's our net sales? 300,000 minus 30,000. That's 270,000. What's our cost of goods sold? X. So to get X, X will be equals to, you bring this here, you bring this here. So that will be 270,000. By the time you bring 150,000 here, it changes to minus 150,000. That gives you 120,000 naira. That's if you want to do it in mathematical terms. If you now use that same logic, that same mathematical logic for this, don't forget our closing inventory is Y. All right. Then we will now say that your cost of goods sold was actually equals to your cost of goods available for sales minus inventory. You know that normally that's from the format. All right. Your cost of goods sold is equal to your cost of goods available for sales minus inventory. Now, our cost of goods sold, we have determined that already. We have determined it to be 120,000. That's 120,000 equals to what's cost of goods available for sale? 170,000 minus Y, closing inventory. So Y therefore equals to 170,000 minus 120,000 equals to 50,000. So these are questions that you can do in under 15 minutes to save time for other tougher or time consuming questions in your exam. Is that fine? So yeah, this is all we have, and then you have your answer. So now let's move on to profit or loss. So of course, yeah, I just noted some things that of course I've explained already. Now take note of the fact that your sales, the sales that we use in trading profit or loss account, is the total of cash and credit sales of goods during the period, and it does not include sales of fixed assets. So if they give you a question, they can put sales of fixed assets there just to confuse you. You have to know that it is not part of the sales that goes, it is not part of the sales that goes into your trading account. Is that fine? Then the same thing happens for purchases. Your purchases is what? Goods bought for the sale. So therefore, it does not include the purchase of fixed assets. It's only the purchase of goods. So if I sell bags of rice, my purchases value is the amount that I spent in order to buy bags of rice. But if I bought let's say a motor vehicle in order to transport that rice, it is a fixed asset. So my purchases does not include it. Do you understand that? So then we have opening stock. Of course, as I explained, the stock of goods available for sales at the beginning of the year or the period. Closing stock, the amount of goods that you have at the end of a period. All right. Carriage in was the cost of transporting the goods to the company. All right. When you go outside to buy that rice, and then you have to incur transport cost to bring the goods to the company. As carriage in was, and it is added to the purchases in the trading account. There are goods withdrawn. I've already explained that too. When you take goods out of the business for personal use, for example, you pick part of your bag of rice and you cooked it to eat personally, or you took it to your house So that's goods return. Then returns outwards and returns, sorry, this is returns inwards. Yeah, so then gross profit is the excess of sales less returns over the cost of goods sold. So sales less return is our net sales or net revenue. Is that fine? So it is the profit made in the ordinary course of business before deducting other business expenses. So if you are selling rice, bags of rice for example, your gross profit is the profit you made from selling rice, assuming that there was no other business expenses. So for example, if you pay rent, you did not come into business to be paying rent, you came to sell rice. Do you understand that? So rent is just a business expense, alright? It's not part of your cost of sales. So that's why your gross profit is what? Sales minus cost of goods sold. Don't forget another name for cost of goods sold um, is cost of sales. Alright. Now let's move on to profit or loss account. Profit or loss account. Now the profit or loss account is used to determine the net profit or net loss of an organization. Net profit or net loss. Now don't forget, profit equals to income minus expenses, and you only have profit when income is greater than expenses. If your expenses is greater than your income, what you have is a loss. Don't forget, greater than, less than. Now you guys have not forgotten. Now using your hand, greater than, less than, less than. Alright, so that's profit. Alright, so the excess of income over expenses is profit. The excess of expenses over income is what? Is loss. Now the profit or loss account is used to determine something called the net profit. Now the net profit is the final profit that you made. Don't forget, you said gross profit is the profit that you made in the ordinary course of business. Now you have not deducted all other business expenses like your rent, your transport, your advertising, all of that. You have not deducted it, but you have your gross profit. Is that fine? Now, your net loss, your net profit is the final profit that you have after deducting all other business expenses. I mean, every expense that was incurred during the accounting period. So, this is arrived at by deducting the business expenses from the gross profit plus any other income. Sorry, I don't know. Alright, so profit, income, expenses. So this is arrived at by deducting the business expenses from the gross profit plus any other income calculated in the trading account. Alright, so it's your gross profit is what we calculate in the trading account. Then you add every other income, then you deduct your business expenses. That's what gives you a net profit or net loss. So don't forget, I told you that the trading account and the profit or loss account is mostly merged together and called the trading profit or loss account. Examples of business expenses include salaries, rent, discount allowed, bad debt, stationery, advertising, depreciation, alright, rate, repairs and main ten ance, increase in provision for doubtful debt, among others. Now let us give a pictorial representation of the profit or loss account. How will it look in real life? Now don't forget, there are two formats to prepare your trading profit or loss account. You have your horizontal format that is also known as the T account. Sorry, the T. or the T format, and we have the vertical format. Now, the T format is called T format because it looks like a T. For example, look at the way we did our trading profit or loss account. You see that this is a T account. We had something go like this and another one like this. So that's T. So that's the same thing we'll be using. The format of your profit or loss account. So you have your debit, you have your credit. So I'm assuming that we are continuing from that account. Don't forget, I told you that they will always be made together. So you can just come here and say profit or loss account. Of course, for the year ended, then you have your date. And let's divide this into two. Don't forget, your income has a credit balance. Your expense has a debit balance. So normally, credit, whenever you are dealing with income, don't forget your profit or loss account is an income account. All right, you want to know the amount of profit that you made. Profit is a form of income. All right, so it is a credit balance account. So every form of income will be on the credit side because income is a credit balance, while every form of debt expense will be on the debit side. Then we compare the two together. Anyone, if your income is greater than expense, don't forget, what are we going to have? Net profit. And if your expense is greater than your income, then we are going to have net loss. So now let's start from the credit side, which is where you put your income. The first thing that you have there is your gross profit. The gross profit from your trading account is going to be transferred here. So it will be somewhere here, then you just bring it back down. All right, then you add other income. So under other income, you can have discounts received, for example, commission received, rent received. Let me zoom it in a little bit so that you guys will see. Maybe decrease in provision for doubtful debts. All right, so that's that. If you have any other income, don't forget this list is a format, so the layout is not exhaustive. Is that fine? So it is not exhaustive. So if you have any other income in the business, you put it there. Then we'll now come here, we'll say expenses. Sometimes you can list it as selling, general and administrative expenses, whatever you like. All right, so let's start. Give me examples of expenses that you know. We have rent. Let's merge the two of them together. Rent and rate. Depreciation. So we have rent and rate, depreciation. We have something like salaries. You guys should give me salesman commission. You guys should give me examples now. Rent and rate, depreciation, advertising, bad debt, increase in provisions for doubtful debt. I gave some. You guys should give me examples now. Repairs and maintenance. Postages and stationaries. And stationaries. So and then and so on and so on and so on and so forth. Now you add all your expense together, you bring it here, you say total expense. So now let us operate on the premise that on the assumption that your total income is greater than your total expense. So you have something like this, you have to put your total income here. This is your total income, all right? The addition of everything that was there. Now, the difference between your total income and your total expense is what will now give you your net profit. Do we understand that? Now, this net profit, it is to be transferred So yeah, I hope you understand that. So that's basically what we have, right? So what we have, and this amount is going to be transferred to the balance sheet to be added to the capital of the business. So if you have loss, net loss, of course, you know that will be the other way around. You are transferring it to the balance sheet, but you are deducting it from the capital of the business instead of adding it. Is that fine? All right. So now let's move on to the balance sheet. Okay, I can give you guys a little example. Let's do this example. There is another question here. Let me use it. So you have something like this. Don't forget, I said another name for your trading profit or loss account is called income statement. So they called it income statement here. That's the debit side, it has the credit side. They had revenue of 820,000 here. Then expenses, rent, office rent, 20,000. Electricity, 15,000. Salaries, 120,000. Then we had miscellaneous expenses. They did not know the figure to that. Then your net income. Net income is still your net profit. Another question mark. Then total. But they did not even write any total yet. So they now said if miscellaneous expense is 10% of revenue, if if expenses is 10% of revenue, what is let's not put it that way. Calculate the net income. So who wants to try their hands on that? Who wants to try their hands on that? In the little time that we have left, who wants to try their hands on that? All right, I think nobody is taking that up, so let's continue. So if miscellaneous expenses is 10%, so the first thing that we'll do is let us calculate what miscellaneous expenses is. Miscellaneous expenses equals to 10 over 100 multiplied by revenue is what? 820,000. So that gives us what? 82,000. Then we have to calculate total expenses. Total expenses is therefore office rent of 20,000 plus electricity of 15,000 plus salaries of 120,000 plus miscellaneous expenses as calculated above 82,000. That gives us total expenses to be what? To be 237,000. Then it means that net income, which will be equal to this income revenue minus your total expenses, is equal to 820,000 minus 237,000. That gives us how much? That gives us an amount of 583,000. Let me check. Yes, that was option A. Yeah. So that's the answer. 583,000. So if you want to do it, you can just edit it. Miscellaneous expenses 82,000, then you have your net income to be 583,000. So there you go. Do we understand that? Any question? Any question? Our time is fast spent. Any question? No? No. All right, Kumi. So let's continue. Then the next one we have is our balance sheet. All right. Now your balance sheet is basically a statement that shows the summary of assets and liabilities. Now one thing that you should know is that your balance sheet is not an account. Your balance sheet is not an account. All right, it is simply a statement, and it shows the summary of assets and liabilities of the business in order to ascertain the financial position of the company. There are three things. It is a statement showing the balance, all right, that is the values of assets, liabilities, and equity at the end of a period. That's what balance sheet is. So it follows the accounting equation that says asset equals to equity plus liability. It means that if you want to write out your trial balance in an hurry, sorry, your balance sheet in a hurry, you are going to have something like this. Now, this is the T format. There is also the vertical format. Don't forget, there is nothing like debit here because it is not a double entry account. It does not have debit and credit. Your balance sheet does not have debit and credit. All right, so you have something like this. Then you come here, your asset is always on the right side. Don't mind me as an accountant, I hardly know my right from my left. What I just know, I know debit and I know credit. So I think this is debit, this is credit. So credit is on my right. So your asset will be on your right, your equity will be here, and your liabilities will also be here on your left, and you have this. Now the point is these two figures, no, these two figures must correlate. They must be the same thing. They must be equal to each other because your asset, according to the accounting equation, your asset must be equal to your equity plus liabilities. Now let's explain what is an asset. All right. Now an asset is basically resources, properties that are owned by the firm and are expected to bring in benefit in the future. So normally, international accounting standards will define assets as a resource, as an economic resource that is owned by an entity arising from past events and from which future economic benefits are expected to flow into the entity. So an asset is anything that you own, that you have, that you expect to give you a benefit in the future. Now, the benefit it will bring might be in terms of cash, might be in terms of the fact that you are using it and it's making life easy for you. For example, your phone, you might not use your phone to make money, but at least you are using your phone to take this class. That's a benefit. Do you understand that? So your phone is an asset. Now there are two major categories of assets. We have the non-current asset and we have the current asset. Another name for your non-current asset is the fixed asset. All right, non-current asset or fixed asset. Then we have current assets. Now, your non-current assets, your fixed assets, they are long-lasting assets which are expected to bring in benefits for a long period of time. You know that the examples of that include what? Your land, your building, your motor vehicle, your equipment, your plant and machinery. For example, when you bought your phone, did you plan to buy your phone so that you sell it next month? No, you bought it so that you would use it to bring more money or to just use it for anything you want to use it for. Do you understand that? So fixed assets are bought for their productive capacity. Why? Because for their usefulness. That's what it means. Because they are useful. You are not buying them majorly for resale. Now let me tell you, any goods that you buy for resale, whether it is for anything that you bought for resale, is what? Is a current asset, is an inventory. Now you have to know this. I always say this: no asset is a current asset by itself. You know that there is this thing whenever you see motor vehicle, you say, oh, motor vehicle is a current asset, is a non-current asset, is a fixed asset. Let me give you this scenario. If I am into the business of selling cars, if we have Mr. A is into the business of selling cars, but Mr. B is into the business of selling bags of rice. If Mr. A buys a car so that he can sell it back, to him it's not a fixed asset, it's an inventory, it is current asset. But if Mr. B buys a car to be transporting his rice, then that's what? That's a fixed asset to him. Let me now burst your bubble. If Mr. A that sells cars buy another car to be used in the office, he did not buy it with the intention of reselling it. He just bought it so that they will be using it. All right, maybe for anything that they might want to use it for. Maybe to maybe for the CEO, for a manager in the firm to use, to be used to run errands within the organizations, or to be used to transport staff when they are going for maybe business meetings, business trips, and all of that. It is a fixed asset to them, even though it's into the business is into the business of selling cars. So it means that to determine between what is a fixed asset and what is a current asset, intention matters. That is, why did I buy it? What was my intention when I was buying it? So any asset that is not bought for the sale but is bought for their productive capacity, for their usefulness, is a fixed asset. And of course, they must also be an asset that will last for a long period of time. It means that we will be able to derive economic benefits from that particular asset for a long period of time. Do we understand that? Then current asset, on the other hand, is an asset that is held for a short period of time and can easily be converted into cash. All right. So they can include inventory. Inventory is goods bought for resale, whether it is car. So far you are buying them for resale. And of course, they must also be in your ordinary course of business. That is the normal thing that you are registered for, that you are doing normally. All right. So inventory. Then we have debtors. Another name for debtors is trade receivables. Those are the people that are owing you one or two monies. All right. We also have cash. Cash is physical cash that you have. Then we have bank. That's cash at bank. We also have something called prepaid expense. Then we have accrued income. Prepaid expense is a current asset. Accrued income is also a current asset. I'm going to explain that when we get to accruals and prepayment. Is that fine? Yeah. All right. So intangible asset also. These are assets without physical substance. Now, if we have intangible assets, it basically means that we also have something called tangible assets. So tangible assets are assets with physical substance. What does that mean? It means that you can see them, you can touch them. For example, your land, your building, your motor vehicle. All right, those are what? Tangible assets, for example. But your intangible assets are assets that cannot be sold. Is that fine? Sorry, assets that cannot be seen. Apologies. All right, I think that's okay. So the assets that cannot be seen. Do you understand that? Those are what? Intangible assets. You cannot see them, you cannot touch them, but they still do what? They bring in economic benefit into the business. An example is goodwill. Goodwill is like the good name, the reputation of the business. All right. Another one is patent. Patent is given for innovation. Then you also have copyright. All right. It's majorly used for with people that write books and all of that. So those are what? Intangible assets. Now you should know that assets are ordered, they are arranged in the balance sheet in the order of permanence. That's why when you are preparing your balance sheet, you start with your fixed asset before you write your current asset. It is because it is arranged in the order of how permanent that particular asset is. Do we understand that? Do we understand that? Do we understand that? Wait, Kumi, you said no at some point in time. What were you saying no to? I don't quite remember why you said no. Okay, no questions. All right, I remember now. Thank you. So other types of assets, of course, include, you're welcome, include tangible assets, fictitious assets. Fictitious assets are false assets. Assets that have no, they are just account balances. They have no specific, they are just balances without any specific economic benefits that they can bring. Then we have wasting assets. Wasting assets are assets like gold mine. All right, the assets that can be used up. For example, for a gold mine, one day you would extract all of the gold, all of the mineral resources that are there. All right, so that's called a wasting asset because at one point in time, it's going to finish, it's going to get exhausted. Then we have liquid asset. Liquid asset are assets that can be easily turned into cash, like very, very easily. They are cash or cash equivalent. Cash and cash equivalent. That's your liquid asset. All right. Any item, so it includes your cash, physical cash, cash at bank, cash put in fixed deposits, treasury bills that will mature within like 30 days. Do you understand that? So now let's move on to liabilities. Liabilities. Now liability is simple. It's just debt. The indebtedness of the entity. All right. So we, as an organization, we owe somebody this particular amount of money. That's a liability. That's what liabilities are. They refer to the indebtedness of the entity. Now, there are obligations arising from past events and which led to a claim by outsiders on the asset of the entity. If I'm owing you money, it means that you have a claim on every money that I have because you want to collect your money back. Do we understand that? So that's what we refer to as liability. So there are obligations arising from past events and which led to a claim by outsiders on the assets of the entity. Now, there are two categories of liability majorly. We have the long-term liabilities and the current liabilities. So just as the name implies, long-term liability basically means that that obligation, you are not expected to settle it in 1 year. Do you understand that? So let's assume I borrow you money. I lend you money and I'm telling you, you must pay back within 5 years or after 5 years. That's a long-term loan. All right. So example of long-term liability, we have long-term loans, we have debentures, we have bonds. Debenture and bonds are the same thing. They are just fancy names of calling long-term loans. Do you understand that? So they are liability, they are debt securities. So it's just a fancy way of saying loan. It's just that the way it works is that they give you a debenture certificate. It's like you are buying it. You tell you to come and buy debentures. They issue debentures to you. You buy it, but effectively you are borrowing the money because there's nothing you want to use the debenture certificate for. The way it just works is that you can also sell that debenture certificate to another person so that when the debenture matures that they want to pay back, they will pay to the holder of the debenture, not necessarily you who gave them the debenture. That's just the way it works. Instead of for long-term loans, they will pay you that gave them the loan, but for debentures, they will pay the holder of the debenture, whoever it is at that point in time. Then we have current liabilities. Now, these are obligations that are expected to be settled within a short period of time. For example, I owe you money and I'm telling you that you must pay in 3 months. That's a current liability, a short-term liability. For example, a short-term loan, creditors or trade payables, sorry, not trade receivables, is trade payables. All right, so it's the same thing as creditors or trade payables. That is the people that we bought goods from. These are our suppliers. All right, that your Mr. Ade, Mr. Olu, that you sold good, that you bought goods from on credit. That's your creditor. Then we have bank overdraft. Don't forget what bank overdraft is. You have taken more than you have from the bank. Do you understand that? You have 50,000 naira in the bank, but you reached an agreement with the bank that allowed you to withdraw or spend more than 50,000 naira. Maybe you later spent 70 or 80,000 naira. All right, the excess of the amount that you spent, that you have, all right, is what? Is bank overdraft. So that extra 20,000 naira that you spent that was not previously in your account is bank overdraft. So it's a debt. So we also have bank loans, all right, any loan to the bank within a short period of time, short-term loans. Then, of course, accrued expense, another one, prepaid income. I will explain accrued expense and prepaid income when we get to accruals and prepayment. All right, now to the last one, we have capital. Now, your capital, what's capital? Capital is the money invested into the business by the owner of the business. So you can say it is the owner's what interest in the business. So it is the excess of assets over the liabilities of the business. and is also referred to as what? Owner's equity or equity capital. So effectively, owner's equity is calculated as what? Asset minus liability. I will not rewrite it. Don't forget our accounting equation. That's your what? Sorry, don't like red. So that's your capital. So capital is what? The money that the owner of the business invests, pumps into the business. Do you understand that? That is what we refer to as what? As capital. Are we together? So the reason we have capital is basically because of the accounting equation. Sorry. Yes, capital plus liability equals to asset. Thank you, Kumi, you are right. While asset equals to, I'm sorry, capital will be equals to asset minus liabilities. So you are correct. So element of financial statement. Oh, sorry. So capital, they can ask you a question like this. We have capital because of the business entity concept. The business entity concept that says that the owner of the business is separate from the business. That's why we have a separate account for capital. Because if they are the same thing, you don't necessarily have to prepare an account for yourself. Do you get? But because we have seen that capital, if you look at capital logically, you are looking at capital in this sense, in the sense of in the face of business entity concept, you are looking at it with the fact that this person is separate from the business, so it means that this money that is given to us is actually borrowing us. Do you understand that? It's actually what? It's actually borrowing us. So while liability is a claim against the asset of an organization by outsiders, capital is like a claim against the asset of the business by the owner of the business. Do you understand that? So that's why it's called owner's equity. Owner's equity or equity capital. All right. So is the essence of asset over liabilities. Now, other forms of capital include your working capital, which is the money you need to run your day-to-day activity. So it is your current asset minus current liability. So that's why it's called the excess of current assets over the current liabilities of a firm. All right. So it is the capital required to run the day-to-day organization. Sorry, to run the day-to-day activities of the organization. Is that fine? So that's working capital. Then we have capital employed. Now, capital employed is the excess of total assets. Don't forget, normal equity is total liability, total asset minus total liability. That's equity capital. But when it comes to capital employed, it is total asset minus current liability. So he's trying to say, where are we seeing money to finance our business? And there are two places where you see money to finance your business. You get money from the owner and you get money from outsider. So that's why it is total asset minus current liability. If you do total asset minus current liability, what are the things that remain? Equity, which is from the owner of the business, owner's equity, plus long term liability. So this is another way to calculate capital employed. In case they didn't give you this one, they can give you this one. Your capital employed is equals to total asset minus current liability or equity plus long-term liabilities. Is that fine? So that's basically the way it works. So now let me draw up the format quickly in the little time we have left. So don't forget, it is not an account, but we are still following the T format. We have something like this. You say balance sheet as at now. Please pay attention. If you are a good student of economics, you know that there is something called flow variable and stock variable. Your balance sheet measures stock variables. That's why we use as at, while your trading profit or loss account measures flow variable. That's why we use for the year ended. Do you understand that? So your income and expenses that are contained in the income and expenses that are contained in your state trading profit or loss account they are flow variables. All right, they move, they change. But stock variable is something that you can check the quantity at a particular point in time. So your asset is a stock variable. So that's why we use sorry that's why we use asset for balance sheet, because it tells us about others about stock variables. So we have naira sign here, we have naira sign here. Don't forget your asset is always on the credit or debit. Your asset is always on the credit or debit side. Which one? None. The answer is the right side. There is no credit and debit in balance sheet. So you come here, you say asset. Don't forget your asset is arranged in order of permanence. So you have to start with fixed assets. All right. Now your fixed assets, we have land and building. Say we have land and building. You have motor vehicle, you have plant and equipment. Yes, you have machinery. Okay, it's plant and machinery. You have furniture and fittings, and so on and so forth. All right, your intangible assets will also come here. So, so add everything. These are our total fixed assets. Then we have current assets. So it says stock. Another name for stock is inventory. Inventory. Then we have debtor. Another name for debtor is receivables. We have bank, cash. Let me just stop there because of space. Then you have something here, it is called total assets. So this is your assets. Don't forget, if we are using accounting information, your capital plus liability equals to asset. If asset is here, then it means that on the other side we have what? Our capital and liability. So let's come here. We say capital X, add net profit. We add it. Now you have to learn something. It is called drawings. Now what's drawings? Don't forget I said anything that is for the business, if taken out for personal use, that's drawings. So if the owner of the business takes out goods, that's drawings. If he takes out money, then that's drawings. So the addition of both cash drawings or goods drawings, anything that was drawn out for personal use is going to be added, is going to be brought here. Everything will be added together and brought here and deducted from equity, from capital to get our closing capital. Why is that? It is still because of business entity concept. Don't forget, if you said as a we are the business, you are the owner. Kumi, let's assume that you are a business now and I own you. If I give you 50,000 naira, you recognize it as capital from the owner, right? You recognize that. Now, if I now pick something from you and use it, for example, I gave you 50,000 naira, you recognize it as capital. Abi? I was now passing by and now said, give me 1,000 naira. If you give me that 1,000 naira and I used it for my personal use, not something, not for you, not for you, the business, then it means that I have taken out of the 50,000 naira that I gave you. By the time come back and say, give me my money back, will you give me 50,000 naira again? No, now you remind me that you have collected 1,000 naira the other time now. So your money, your remaining balance is now what? Your balance is now 49,000 naira. So that's what it means. You have to deduct. That's why we are deducting what? Drawings. Then after this, we can move to liabilities. We start with long-term liabilities. And don't forget, under that, we are going to have long-term loan and debentures. Let's just stick to these two. So this is the addition. Then we have current liabilities. Now under current liabilities, we are going to have creditors. Another name for creditors is payables. Sorry, it's payables. I just like to call it funnily. I'm mimicking somebody. All right. So payables, creditors or payables. Then we also have, let's say, short term loan. And then say accrued expenses, prepaid income. Don't forget, prepaid expense can also come here. But okay, this is what we do. So we have bank overdraft. We don't have space, so let's just add it. But prepaid income will come here. Accrued expense will also come here. Here you have prepaid expense and accrued income. Don't forget, accrued income and prepaid expense are current assets. Prepaid income and accrued expense are current liability. So by the time you add this together, you add everything. Equity, don't forget, this is your equity. That's capital. Capital plus long-term liability plus short-term liability. This is total liability. When you add it to capital, you have this. This is your total equity and liabilities. All right, total equity and liabilities. So, but at the end of the day, use my red pen. At the end of the day, these two figures must be equal to each other. Those two figures must be equal. Now, if they are not equal, then there's something wrong with your balance sheet. There is what? There is something wrong with your balance sheet. So, with this, because of our time, although we still have things to talk about, but we'll talk about other stuff. We have actually talked about final accounts. All right, we just talk about adjustment to final account, and that's what we'll be doing in our next lecture. Because of our time, I want to end the class now. But don't forget, let me just tip this. At the end of the day, we want to know, nobody will tell you to do all of this in your JAMB, in your UTME, all right? Because, of course, it's not a theory exam, but they can ask you to calculate closing capital. This amount right here is closing capital. So you can have something like opening capital, add, sometimes you used to have additional capital. So you have to add, please jot all of these things down. So you have opening capital, but some questions are not correct on balance sheet. So you are saying that some questions, they will not balance, abi? If it does not balance, then it means that something is wrong. You must have made a mistake somewhere, whether in your addition here or from your trial balance. Normally, if you do everything correctly, your capital plus liability must be equal to assets. It's the accounting equation. Is the basis of everything, of almost everything accounting. Your total asset must be equal to your total capital plus liability. Now, so far the question is correct and you do everything correctly, boom, balance, it will be equal. The two sides will agree. Do you understand that? So, except the question itself is not correct though. You always have headache while solving it. No, it's actually not hard. Now this is JAMB, this is UTME prep, so we might not really be able to solve a full question because in actual sense we don't need it. All right, so we will not be able to solve. But if you balance sheet is just the combination of everything that you have learned. Because why? These things are final accounts. If you don't get your ledgers correctly, your balance sheet cannot be correct. Because at the end of the day, it is all those. Okay, for example, your net profit now, you got it by saying sales. You got it by first getting gross profit, and your gross profit is sales minus cost of sales. Now, if you don't get your sales account correctly, it means that your sales there, your sales in the in the trading account will not be correct. If your sales is not correct, there's no way your net profit will be correct. So it has affected your balance sheet. Your balance sheet will not be correct too. So if you add all those little knowledge together, everything will turn to odidi, whole. And then you so but I understand the part of you having a headache while solving it. But the thing about this thing is what is practice. And see, I've been there, so I understand how hard it can be to solve questions in accounting. If it's I can say that it's actually easier to solve questions in mathematics than to solve questions in accounting. Because, for example, now, if I want to learn trial balance in accounting, I cannot just learn trial balance by knowing that debit, these things are on the debit and these things are on the credit. I must be able to do subsidiary books and ledgers. So what I did at some point in time was that I don't like it normally because I don't even like. To me, it's just stress. Why do I have to do all of these things just because of one trial balance? But it's necessary. So I used to like push myself to write everything. I mean, to get a question that I will solve from scratch. So I'll solve it from subsidiary books to ledgers, and by myself, I will draw out my trial balance. So I will not look for a question that they would have drawn the ledger. I will just use the ledger to draw trial balance. That's not how to practice accounting. You only know how to draw a trial balance. You don't know how to do the accounting itself. So I will go back, learn. I will start it from the very beginning, like you're having real transactions. So from subsidiary books to the ledgers and then to trial balance. Then sometimes I will now take it from that trial balance again to trading profit or loss account and balance sheet. That's how you know accounting. But I must tell you, it's very stressful. It's not as easy as it sounds. Yeah, it's at all. It's not as easy as it sounds. But you should do it. You should do it. Those things they help actually. Especially if you don't just want to, if you are not just reading to pass exams, you are reading to actually know that thing and be good when you get to secondary school. Because these are the things that you still do when you get to when you get to university, higher institutions. These are the things that you will start with before you get into those serious things. All right, and this is the basic for everything. If you don't know this one, there are many things that you will struggle with, but these are like the major things. Do you understand that? So it's not even all those branch accounts, royalty. It's not those type of accounts that are actually the hard accounts. Those ones are special accounts. They don't happen every time in real life. These are the accounts that happen every business, no matter what kind of business, even a branch business, departmental business will prepare balance sheet. Every single business, but not every business will prepare branch account now. So they are called special accounts. They are just useful for specific cases. So so you can have a question that will circle around you calculating this, that will circle around you calculating maybe fixed assets or total assets and so on and so forth in your JAMB. So that's just the way it works. All right. Because of our time, thank you so much, guys, for listening. We have come to the end of today's class. And please, I wish you I wish you all success as you prepare for your examinations. Please kindly do well to practice a lot of questions. It's very, very important. Practice makes perfection. So practice a lot of questions. All right, that's actually the major thing there. So I actually want you guys to solve questions, get confused, then bring it to class. We will demystify it. There's nothing as accounting. You just have to understand how it works. There's nothing there. So if you are doing anything and then it's like I don't really understand this, write down the question, snap the question, write it out, bring it here and let us solve it together. So thank you guys. Thank you so much for listening. Do well to have a great night rest and do well to have a nice time preparing for your exams. I pray you all success as you do so. Bye. God bless you.